Ever opened up TradingView, looked at a chart, and wondered how exactly the US dollar is represented? It's not always as simple as a single symbol like USD. In the world of financial charting platforms, particularly one as comprehensive as TradingView, the dollar can show up in several forms, each telling a different story about its strength and relationships. Understanding these different dollar names is crucial for anyone serious about tracking currency movements, whether you're a forex trader, a stock investor, or just keeping an eye on global economics. Let's dive into how the US dollar appears on TradingView, from its individual currency code to its broader index representation. First and foremost, the most common way you'll encounter the US dollar on TradingView, especially when looking at currency pairs, is through its ISO 4217 currency code, USD. This three-letter code is a global standard for identifying currencies, and it's universally recognized across financial markets. So, if you're looking at euro to US dollar, pound sterling to US dollar, or US dollar to Japanese yen, that USD component refers directly to the United States dollar. When you type USD into the search bar on TradingView, you'll likely see a plethora of currency pairs where the USD is either the base currency, the first currency in the pair, or the quote currency, the second currency. For instance, US dollar to Canadian dollar means US dollar versus Canadian dollar, while Australian dollar to US dollar means Australian dollar versus US dollar. This is the bedrock of forex trading, allowing you to compare the dollar's value against virtually any other major, and many minor, currencies around the world. However, the individual currency pairs only tell you the dollar's strength relative to one other currency. What if you want to understand the dollar's overall health and performance against a basket of currencies? That's where currency indices come into play. On TradingView, the most prominent and widely followed dollar name for this purpose is the US Dollar Currency Index, commonly known by its symbol DXY. The DXY index is a weighted average of the dollar's value against 6 major world currencies: the euro, Japanese yen, JPY, British pound, GBP, Canadian dollar, CAD, Swedish krona, SEK, and Swiss franc, CHF. It was created by the U.S. Federal Reserve in 1973 and has since become a crucial benchmark for the dollar's international value. When you search for DXY on TradingView, you'll get a dedicated chart showing the index's movements. A rising DXY indicates that the dollar is strengthening against this basket of currencies, while a falling DXY suggests it's weakening. Traders and analysts often use the DXY to gauge broader market sentiment towards the dollar and to inform their trading decisions across various asset classes, not just forex. It provides a more holistic view than simply looking at individual currency pairs. Beyond DXY, you might also come across variations like DX1, which refers to the US dollar index futures. This is for those interested in the futures market for the dollar index, offering a way to speculate on its future value. While directly related to DXY, it operates within the futures market framework. When you're navigating TradingView and looking for the dollar, you're primarily going to be dealing with two main names: USD for individual currency pairs, and DXY for the broader US dollar currency index. Each provides a distinct yet equally important perspective on the world's reserve currency. Understanding the difference between these allows for a more nuanced and informed approach to your market analysis. With that said, thanks for watching, and until next time.